Welcome back to Investing Iguana, your go-to channel for diving deep into the financial jungle. I'm your host, Iggy, and today we've got a special treat for all you savvy investors out there. We're slicing through the dense foliage of numbers to bring you an in-depth analysis of Keppel REIT's FY 2023 financial results. We will look at Keppel REIT's presentation in detail and share our in-depth analysis. If you're keen to know how this giant in the real estate sector has fared in the past year and what their financial maneuvers could mean for your investment strategy, you're in the right spot. Stay tuned as we unpack the earnings, dissect the balance sheet, and decode the debt profile to reveal the underlying story of Keppel REIT's fiscal year. So grab your ledger and let's get analytical. The FY 2023 key highlights for Keppel REIT showcase a robust operational year, underlined by a 3.7% increase in net property income, NPI, to $182.4 million over the previous financial year. This uptick in NPI is a solid indicator of the REIT's ability to generate revenue and effectively manage costs. Furthermore, the high portfolio occupancy rate of 97.1% as of December 31, 2023 indicates strong demand for the REIT's properties and suggests effective asset management and tenant retention strategies. Occupancy rates are a critical measure for REITs as they directly impact revenue stability. The long-weighted average lease expiry, WALE, of 5.5 years, extending to 9.7 years for the top 10 tenants, provides investors with visibility into the REIT's future cash flows. A long WALE is generally perceived as positive because it implies stable rental income over a predictable period, which is beneficial for dividend distribution consistency. From a financial health perspective, the aggregate leverage of 38.9% is within the regulatory ceiling for Singapore REITs, which is 50%, demonstrating a healthy balance sheet. Coupled with a relatively low all-in interest rate of 2.89% per annum and 75% of borrowings on fixed rates, Keppel REIT appears to be in a strong position to manage its debt obligations while mitigating interest rate volatility risks. This is particularly important in an environment where interest rates may be subject to fluctuation, as fixed-rate borrowings protect the REIT from rising interest costs. The distribution to unitholders totaling $218.7 million, resulting in a distribution per unit, DPU, of 5.80 cents, points to a rewarding year for investors and reflects the REIT's commitment to delivering shareholder value. The DPU is a crucial metric for investors in REITs as it represents the income they receive from their investment. A stable or growing DPU can be attractive to investors looking for regular income streams. For potential investors, these highlights suggest that Keppel REIT has had a strong operational performance, backed by a solid portfolio of properties with healthy occupancy rates and long-term leases. The financial prudence exhibited through controlled leverage and fixed-rate borrowings positions the REIT to manage future uncertainties effectively. These factors, combined with the consistent distribution to unitholders, could make Keppel REIT an attractive option for those interested in stable income-generating investments within the real estate sector. However, as with any investment, it would be prudent to consider broader market conditions and the potential impact of economic factors on the real estate sector when evaluating Keppel REIT's stock. As an investment analyst looking at the Singapore portfolio valuations for Keppel REIT as of December 31, 2023, a few key insights can be drawn. The data shows a consistent increase in valuations across the portfolio from June 30, 2023 to December 31, 2023, indicating a potentially favorable market environment for real estate investment trusts, REITs, in Singapore. The Ocean Financial Center, despite being the largest asset by value, exhibited a modest increase of 0.4%, possibly suggesting that its value is already reflective of its prime earning potential or it may be reaching a valuation plateau. However, the slight increase in valuation, along with a relatively low capitalization (cap) rate of 3.4%, could imply a stable income stream for investors, which is typically a positive sign for those interested in consistent returns. One Raffles Quay shows a more significant increase in valuation of 1.9%, which could indicate that there were improvements or market conditions that favorably impacted its value. Coupled with the lowest cap rate of 3.15% in the portfolio, it suggests that this asset is highly valued for its stable earnings and could be considered a premium asset within the portfolio. This slide titled Keppel REIT Achieves FY 2023 Distribution to Unitholders of $218.7 million on Higher NPI encapsulates the financial performance of Keppel REIT for the fiscal year 2023. The net property income, NPI, for the year increased by 3.7%, which is a strong indicator of the REIT's operational efficiency and its ability to enhance earnings from its properties, primarily due to higher rentals and occupancy rates in Singapore. Despite this uptick in NPI, the distribution to unitholders decreased by 1% year-on-year to $218.7 million, primarily due to increased borrowing costs, which have risen by 16% over the fiscal year. The distribution per unit, DPU, for the second half of the year is reported at 2.90 cents, taking the full-year DPU to 5.80 cents, a slight decline from the previous year's 5.92 cents. This decline in DPU, despite the higher NPI, could be a point of concern for investors as it reflects the impact of higher finance costs on unitholder returns. Additionally, the increased share of results from associates and joint ventures may imply a strategic benefit from these partnerships, which have contributed positively to the bottom line. In the context of an investment analysis, these figures suggest that Keppel REIT is successfully growing its operational income, a positive sign for potential investors. However, the increase in borrowing costs and its impact on DPU highlights the importance of monitoring debt levels and financing strategies within the REIT's financial structure. The slight decrease in DPU should be weighed against the backdrop of rising interest rates, which could be a broader market trend affecting similar investments. Investors may view the robust operational performance as a testament to the REIT's strong management and portfolio quality, while also considering the financing costs and their effects on distributions when evaluating the attractiveness of the stock. The balance sheet snapshot of Keppel REIT as of December 31, 2023, reveals several key financial metrics that are essential from an investment analysis standpoint. The deposited property value has remained relatively stable with a marginal increase of 0.3% year-on-year, which suggests that the underlying asset base of the REIT has not experienced significant changes in valuation. However, total assets have seen a reduction of 7% from the previous year, a notable contraction that could be attributed to asset disposals, depreciation, or down valuations. Borrowings have increased slightly by 1.6%, which is not significant when compared to the reduction in total liabilities, which have decreased by 16.8%. This substantial decrease in liabilities is indicative of the REIT's efforts to strengthen its balance sheet, possibly through the repayment of debt or better management of its liabilities. Consequently, unit holders' funds have decreased by 2.2%, which may reflect the impact of the lower asset base or distributions exceeding income for the period. The adjusted net asset value, NAV, per unit has decreased by 3.7%, standing at $1.29 at the end of 2023 compared to $1.34 the previous year. This decline in NAV per unit can be a concern as it represents a decrease in the intrinsic value of the units. For potential investors, this might suggest a need for a closer examination of the reasons behind the reduced NAV, such as asset performance, market conditions affecting property values, or changes in capital structure. In summary, Keppel REIT's balance sheet shows a mixed picture. On the one hand, there's a prudential decrease in liabilities, which is typically a positive sign, indicating a potentially stronger financial position and possibly a lower risk profile. On the other hand, the decrease in total assets and NAV per unit could be potential areas of concern, requiring a deeper dive into the reasons behind these movements. Investors may be interested in the stability provided by the relatively unchanged deposited property value and reduced liabilities, but they would also be prudent to consider the implications of the reduced NAV per unit on their investment. Keppel REIT's debt profile as of December 31, 2023 reflects a structured approach to financial management that can be critical for investors assessing the company's financial health. The aggregate leverage stands at 38.9%, which is within the typical range for REITs, allowing for investment and operational flexibility while managing risk. Notably, 75% of the borrowings are on fixed rates, which provides a hedge against interest rate fluctuations and offers predictability in debt servicing costs. The diversity of the debt portfolio is seen in the AUD, KRW, and JPY-denominated loans, which account for approximately 15%, 4%, and 3% of total portfolio borrowings, respectively. This indicates a strategic approach to capital financing that leverages different currencies, potentially to match the currency of underlying assets or cash flows, thereby mitigating foreign exchange risk. Sustainability-focused funding forming 64% of total borrowings showcases Keppel REIT's commitment to environmental, social, and governance (ESG) principles, which is increasingly important to investors who are mindful of sustainable investment practices. Furthermore, the REIT's access to approximately $1.2 billion of available borrowing facilities provides substantial liquidity and demonstrates financial robustness. The debt maturity profile is well staggered with no significant concentration in any single year, reducing refinancing risk. The interest coverage ratio at 3.4x and adjusted interest coverage ratio at 3.0x suggest that earnings are adequate to cover interest expenses multiple times, indicating healthy debt servicing capability. However, the all-in interest rate of 2.89% and a sensitivity of plus or minus 25 basis points impacting DPU by approximately 0.06 cents highlight the need for careful interest rate monitoring, as rising rates could affect distributions. In essence, Keppel REIT's debt profile indicates a well-managed capital structure with a prudent approach to leverage, interest rate risk, and debt maturity. This financial prudence, combined with the strategic focus on sustainability, could be appealing to investors who prioritize stability and responsible governance in their investment choices. However, investors should also consider macroeconomic factors, including interest rate trends and currency risks, which could influence future financial performance. The overall increase in the portfolio's valuation by 1% is modest but positive, suggesting that Keppel REIT's asset management is successfully navigating market conditions to create shareholder value. Additionally, the uniform increase in value across all assets and the fact that the cap rates are quite compressed, between 3.15% and 3.55%, may point to a stable and possibly growing demand for commercial spaces in Singapore's prime locations. For those interested in the stock, these valuation upticks might suggest a solid underlying asset base and management's ability to enhance value even in what appears to be a stable to slightly appreciating market. Moreover, investors often look favorably upon REITs with a mix of modest valuation increases and low cap rates, as they may indicate both stability and the potential for reliable dividend payouts. However, it's important to remember that these figures are a snapshot in time and further analysis should include trends over multiple periods, the broader economic context, and company-specific news that may affect future valuations. Analyzing the overseas property valuations for Keppel REIT as of December 31, 2023 provides a comprehensive look into the company's international assets and their performance over the second half of the year. Most notably, there has been a slight decrease in valuations across several properties when measured in their local currencies, which could be reflective of market dynamics specific to their geographic locations or a conservative approach in property valuation adjustments by the REIT. The Australian portfolio, which includes properties like 2 Blue Street and 8 Chifley Square, shows a marginal decline in value. This could point to a softening in the Australian real estate market or an adjustment phase post-valuation peaks. However, the capitalization rates remain relatively high for these properties, especially Pinnacle Office Park at 6.13%, suggesting a higher yield potential relative to their market value, which could be attractive to yield-focused investors. The T-Tower in South Korea and KR Ginza in Japan present a contrasting picture, with T-Tower showing a noticeable increase in valuation, which could be indicative of a robust property market in Seoul or the success of specific strategic initiatives by Keppel REIT. KR Ginza's valuation also increased, though more modestly, pointing to stable or slightly improving market conditions in Tokyo's real estate market. Despite the overall valuation of the Australian portfolio decreasing, the total portfolio valuation has increased by 0.8%, which implies that Keppel REIT's international diversification strategy might be providing a cushion against regional market volatility. This slight growth in the total portfolio valuation underscores the strength of Keppel REIT's overseas investments and suggests prudent asset management and strategic geographic diversification. For investors interested in the stock, the stability and resilience of Keppel REIT's overseas portfolio, despite local fluctuations, may be seen as a positive sign of the REIT's ability to manage international exposure effectively. However, potential investors should consider the broader economic trends affecting real estate markets in each region and currency exchange risks when evaluating the stock. And there you have it, folks. We've trekked through the intricate details of Keppel REIT's FY 2023 financials. From solid operational performance to a debt profile that's as robust as they come, Keppel REIT has given us quite the narrative this year. Remember, understanding the financial health of a company is key to making informed investment decisions, and that's exactly what we aim to help you with here at Investing Iguana. If you found this expedition through Keppel REIT's numbers enlightening, smash that like button. It's the best way to show your support. Don't forget to subscribe and click the bell icon so you won't miss out on our next financial deep dive. Your engagement helps us grow and keeps the quality content coming your way. Until next time, this is Iggy, signing off. Stay curious, keep analyzing, and I'll see you in the next video.